Hello everyone. Now let's continue our discussion for Chapter 10 about liabilities. And now we're going to be talking about payroll liabilities. So in accounting, payroll refers to the amount paid to employees for services they provided during a specific period. A company's payroll is important for many reasons, but the most important reasons are the following. The first thing is that payroll and related payroll taxes significantly affect the net income of most companies. In some cases, the amount of payroll expenses and salaries is considered to be almost 50% of the entire or the total amount of expenses that the company pays. Also, payroll is subject to federal and state regulations, so we have to follow the federal and state laws when it comes to how we pay the payroll. Also, good employees' morale requires payroll to be paid timely and accurately. One of the worst feelings is that it's end of the month or the beginning of the next month and you're not getting your salary or your wages. So in this case, it has a huge impact on the employees' morale. So the word salary usually refers to payments for managerial and administrative services, and salary is normally expressed in terms of a month or a year. So somebody asks someone how much you're making a year, then you're asking them for their salary. Wages, on the other end, usually refers to payments for employees' manual labor. So the rate of wages is normally stated on an hourly or a weekly basis. So the salary or wage of an employee may be increased by bonuses, commissions, profit sharing, or cost of living adjustments. The Fair Labor Standards Act, sometimes called the Federal Wage and Hour Law, requires employers to pay a minimum rate of 1.5 times or 1.5 times the regular rate for all hours worked in excess of 40 hours per week. So every week an employee is required to work, it's not required, but if they work 40 hours they just get the hourly rate. But if they work over 40 hours, then each extra hour has to be paid as 1.5 times the regular rate. So exemptions are provided for executive, administrative, and some supervisory positions. So let's see this example. John T. McGrath is a salesperson employed by McDermott Supply Company. McGrath's regular rate is $34 per hour, which I think is a very good rate. And any hours worked in excess of 40 hours per week are paid at 1.5 times the regular rate. So we're going to add $17 to the 34, which makes it $51 per hour for any kind of work that's done above the 40 hours per week. So McGrath worked 42 hours for the week ended December 27. So you can see here there are 2 extra hours. His earnings of $14.62 for the week are computed as follows. So as you can see, the earnings at a regular rate, which was the $34, is calculated as 40 hours multiplied by $34, that's $13.60. And then for the overtime, which were 2 hours during that week, these are multiplied by 34 multiplied 1.5. So that would be 102. Add them together and that's going to be $14.62. So deductions from employees' earnings. The total earnings of an employee for a payroll period, including any overtime pay, are called the gross pay. From this amount is subtracted one or more deductions to arrive at what we call it the net pay. So the net pay is the amount paid the employee. So when we say, let's say you're working at $20 per hour for 40 hours, you expect to receive like $800 per week. But in reality, there are some deductions. And let's say the deductions turn out to be, let's say, $150. So out of the 800, you receive 650. The 650 is called the net pay. So net pay is the amount paid paid the employee. The deductions normally include federal, state, and local income taxes, medical insurance, and pension contributions, and could be also some other voluntary deductions. So now let's talk about income taxes. Employers normally withhold a portion of the employee's earnings for payments of the employee's federal income taxes. So that's pretty normal. The employer is required by the IRS to deduct part of your income as federal income tax. They don't pay you the whole amount and then you pay the taxes later on. It has to be deducted by the employer, and the employer would pay the IRS and also the state taxes, the amount of the federal income tax and the state income tax. So each employee authorizes the amount to be withheld by completing an employee's withholding allowance certificate, which we call it the W-4. I'm not quite sure if you're familiar with the W-4 and the W-2. The W-2 is the some kind of form that we receive at the end of the year, or usually at the beginning of the following year, that shows all the income that you made during the year, or your payments. The W-4 is a different form. W-4 is a form where you tell your employer how much you can deduct from you, based on whether you're single or married, and how many allowances are you willing to have to deduct. So on the W-4, an employee indicates marital status and the number of dependents, if any, of course. Each dependent reduces the federal income tax withheld from the employee's pay. So the more dependents I have, the less the amount of deductions that would be deducted from my gross pay. Other income, example, second jobs, interest income, and deductions, as well as extra withholdings, may be also listed. And here's an example of the W-4. I think the main thing I want to focus on is, like you see here, a check mark next to single or married, filing separately. This is where you decide like how you want to have your deductions like implemented based on your marital status. So for FICA tax, FICA stands for Federal Insurance Contributions Act, and employers are required by FICA to withhold a portion of the earnings of each employee. The FICA tax withheld contributes to the following two federal programs: Social Security and Medicare. So on top of the federal tax, state tax, we also have to pay FICA tax, which is Social Security and Medicare. So Social Security, which provides payment for retirees, survivors, and disability insurance. Medicare, on the other end, is again a payment that we make, which provides for health insurance for senior citizens. The amount withheld from each employee is based on the employee's earnings paid in the calendar year. The withholding tax rate and maximum earnings subject to tax are often revised by Congress. So every year there is always like a maximum amount that can be withheld based on your salary. After a specific amount, they don't keep taking more Social Security or deducting Social Security. At a certain point, it just stops. For Medicare, there is no limit. It usually keeps going up with whatever you make every year. So for Social Security, it keeps going up year after year because, again, of inflation, and it's expected that the average salaries or payments for employees will keep going up year after year. So assume the following rates and earnings subject to tax, which, by the way, they're not very accurate, but they're just close enough to real numbers. So Social Security was 6% on all earnings, and Medicare is 1.5% on all earnings. And John T. McGrath earnings for the week ending December 27th are $14.62, and the total of FICA tax to be withheld is $109.65. And these are computed as follows. So you see here the earnings subject to 6%, or the $14.62, multiplied by the 6%, and that gave us a Social Security tax of $87.72. For the earnings subject to 1.5%, it's the same value, $14.62, and the Medicare tax rate is 1.5%, and it's $21.93. The total for FICA is $109.65. At a very high level, this value, like if you do it for an annual amount, at some point the Social Security tax earnings are going to be limited to a specific number. So let's say somebody made, let's say $170,000 a year, which is pretty high. At a certain point, let's say This year, like in 2021, the government decided that anything above 130,000 is not going to get taxed. So there's usually a limit for Social Security, but for Medicare there's no limit. So employees may choose, on top of that, these kind of deductions, employees may choose to have additional amounts deducted from their gross pay. An employee may authorize deductions for retirement savings, charitable contributions, or life insurance. A union contract may also require the deduction for union use. So now let's compute the employee's net pay, how it's done. I think it's pretty straightforward. Most of it, we start with the gross earnings and then we deduct everything that we just talked about. So the gross earnings less payroll deductions equal net pay, which we sometimes call it the take-home pay. So assume that John T. McGrath authorized weekly deductions of $20 for retirement savings and $5 for a United Fund contribution, which is the union. And assuming that the $257 of federal income tax is withheld, McGrath net pay for the week ended December 27 would be this value, which is $1,069.40, which is computed as follows. You see here the gross earnings, $1,462, and then the deductions. We have the Social Security tax, we have the Medicare tax, we have the federal income tax, we have the retirement savings, and then finally $5 for United Fund. So these last two, the $20 and the $5, these are voluntary kind of deductions, but Social Security, Medicare, and the federal income tax, these are things that we have to pay. And again, in this example, we didn't go into state income tax, which is another category. Some states, they don't pay state income tax, and maybe this is why this example did not want to include the state income tax, to avoid any kind of confusion. So the employer's payroll tax. On the other side, when you hire employees, you pay them their salaries, you deduct FICA from them, you deduct also the federal tax, but you also have to pay taxes for the people they work for you. So it's not just a salary. You have to pay something called FUTA and SUTA. On top of that, you also match what your employee paid in FICA. So you match the FICA, you paid FUTA and SUTA. So let's try to understand what is FUTA and SUTA. So employers are subject to the following payroll taxes for amounts paid to their employees. The first thing, the FICA tax. And employers must match, and I want you to remember that, they must match the employees' FICA tax contributions. So dollar for dollar. So I hate to put it that way, but it's in reality like the government is double dipping. So they're getting taxes for Social Security and Medicare from the employees, and also the same amount from the employer. And then there's the federal unemployment compensation tax, known as FUTA. And this is for employees who would lose their job for whatever reason. So the government is going to pay them for the period where they are unemployed. So this employer tax provides for temporary payments to those who become unemployed. So the tax collected by federal government is allocated among the states for use in state programs rather than paid directly to employees. Congress often revises the FUTA tax rate and maximum earnings subject to tax. State unemployment compensation tax, very similar. This employer tax also provides temporary payment to those who become unemployed. The FUTA and SUTA program are closely coordinated, with the states distributing the unemployment checks. So SUTA tax rates and earnings subject to tax vary by state. So they're not the same amount because, again, states are different. Like in California, the minimum wage is much higher compared to other states. So this would just make you aware that SUTA has to be higher in California compared to other states. So again, this exhibit here shows the government, and it's taking Social Security, Medicare tax, and the federal withholding tax from the employee. And from the employer, they're going to match the Social Security and the Medicare, dollar for dollar. But for federal unemployment compensation tax and state unemployment compensation tax, both of these are only the responsibility of the employer or the business. So in reality, the employee pays three types of taxes: Social Security, Medicare, and federal taxes or federal income tax. The employer, on the other side, pays the same amount for Social Security and Medicare, but they also pay for FUTA and SUTA. Now let's see an example for recording payroll. So the payroll liabilities are normally recorded at the end of each payroll period. The following data for McDermott Supply Company for payroll period ending March 21st are used. So we have payroll sales salaries to be $20,000. Office salaries are $5,000. So the sales salaries, these are employees who work in the sales. Office salaries may be like the CEO of the company, any kind of administrative assistants or secretary or something like that. And salaries subject to payroll taxes for Social Security and Medicare is $25,000. For state and federal unemployment taxes, only $10,000. So we are also given the payroll tax rates. We have the Social Security tax 6%, Medicare tax 1.5%, for SUTA, or the state unemployment compensation tax is 5.4%, and for federal unemployment compensation tax is 0.8%. And remember, that's 0.8%. So the employee deductions would be the federal income tax withholding, the state income tax withholding, retirement contributions, and charitable contributions. So we're going to deduct these values. And for the employer, we're going to use these percentages. So let's start with the journal entry that shows the sales salaries and the office salaries. So you can see here, since these are expenses, we're going to record $20,000 for the sales salaries expense. Office salaries expense is going to be $5,000. And then the Social Security tax is going to be 6% of the $25,000, which was already calculated here to be, actually it wasn't calculated here, we have to calculate that ourselves. So 6% multiplied by the 25,000, that's 1,500. And the Medicare tax payable is 25,000 multiplied 1.5%, that's 375. So the employee's federal income tax payable is 2,100, and the employee state income tax payable was 5,550, and these were given here in the previous slide. Then there were retirement contribution payable and charitable contribution payable. These were voluntary. And then the net difference between the gross salary and these deductions is the net payment here, which is the salaries payable for $19,025. So as we mentioned before, employers must match the employee's Social Security and Medicare taxes. In addition, an employer must pay the state and federal unemployment compensation tax. And the employer's payroll taxes of $24.95 for the March 21st payroll are calculated as follows. We still have the 6% and 1.5% for Social Security and Medicare. These exactly match what we deducted from the employees. Then we have the SUTA and FUTA here, which are 5.4% of the 10,000 and 0.8% out of the 10,000. And these are $540 and $80. And when we add them together, this is $24.95, which are the total responsibility of the business or the employer. So how the business would record the journal entry for that? So we'll have payroll tax expense on the debit side. Remember, that's an expense. And then we show all the liabilities: Social Security tax payable, Medicare tax payable, SUTA or state unemployment tax payable, and federal unemployment tax payable for $540 and $80. So each one of these is a liability that has to be paid within the due date. So paying the payroll, that's the next thing. So companies pay employees either by electronic fund transfers or by issuing payroll checks. With electronic fund transfers, the employee's net pay is electronically deposited into their bank account each period. And I think that's the case in most businesses nowadays. I think like the paycheck, physical paycheck is getting to be less and less over time. The employees receive a payroll statement summarizing how the net pay was computed. Most companies use a special payroll bank account for payroll. In such cases, payroll is processed as follows. So the reason they have a special payroll bank account because they don't want to show different transactions with the payroll transactions. So they usually assign a special bank account that's only responsible for payment of employees' salaries and wages. And that would minimize any kind of confusion with other payments to suppliers and vendors and utilities and rent and all these other things. So the total net pay for the period is determined. The company authorizes an electronic fund transfer or EFT from its regular bank account to the special payroll bank account for the total net pay, and individuals' EFTs or payroll checks are dispersed from the payroll account. One more thing here, we want to talk about internal controls for payroll. The controls described in Chapter 7 also apply to payroll, and one of the major things about big companies is sometimes they hire fake employees and then someone else would pick up the check for them. So some examples of payroll controls include things like the hiring and firing of employees should be properly authorized and approved in writing. All changes in pay rates should be properly authorized and approved in writing, otherwise people will start getting raises that are not authorized. Employees should be observed when arriving to work, and we need to verify that these employees are checking in for work only once and only for themselves. Employees may check in for work by using a time card or by swiping their employee's ID card. And also a special payroll bank account should be used as mentioned before. A couple more things. Employees' fringe benefits. So many companies provide their employees benefits in addition to salary and wages. These may include vacation, medical, and retirement benefits. And the cost of employees' fringe benefits is recorded as an expense by the employer. One of those things that are a little bit sensitive is vacation pay. So for vacation pay, most employers provide employees vacation, sometimes called compensated absences. The liability to pay for employees' vacations could be accrued as a liability at the end of each pay period. Many companies wait and record an adjusting entry for accrued vacation at the end of the year. And we'll see an example for that. So assume that employees earn 1 day of vacation for each month. So that means like it's 12 months or 12 days per year. The estimated vacation pay for the year ending December 31st is $325,000. So the adjusting entry for the accrued vacation would be as follows. Again, it's very simple here. I'm not expecting you to do the calculations. It's given to you. So we'll debit at year end, and remember this is an adjusting entry, so we're going to debit vacation pay expense and we credit vacation pay payable for $325,000. Why it's payable? Because it's not going to be used or paid, in other words, until the employee actually takes vacation. So employees may be required to take all their vacation time within 1 year. In such cases, any accrued vacation pay will be paid within 1 year. The vacation pay payable is reported as a current liability on the balance sheet. If employees are allowed to accumulate their vacation pay, the estimated vacation pay payable that will not be taken within a year is reported as a long-term liability. So I know this is a little bit intense, a lot of concepts. I hope this is not too confusing. So let me stop here, and in the next video we'll talk about pensions.